Section 17, real estate calculations you're going to need to know. Computations. You have parts of a fraction. You have the numerator and denominator. Numerator on top, denominator on the bottom. You need to be able to change fractions to decimals, decimals to percentages, percentages to decimals, and understand your decimal place values. To calculate linear feet, you double the length and double the width and then add it together. A little bit about land units and measurements. Front footage generally refers to the number of linear feet that the property has facing the street. Or if we're talking about waterfront property, it would be facing the waterfront. So the more front footage a commercial property has, the more it's worth. Front feet times value per front foot is going to give you the value of the property. Cost per front foot. That is the amount sold divided by the front feet. Calculating area and volume. For a rectangle, it's the length times the width. For a square, it's side times side. And for a triangle, it's half the base times the height. Calculating volume. Rectangular prism, you take the length times the width times the height. If it's a cube, you're going to take side times side times side. Some important measurements to remind you about. A yard is 3 feet. An acre is 43,560 square feet. And a mile is 5,280 linear feet. All right, in your math, you're going to have prorations. That's what we were talking about in the last slide about being divided by the buyer and the seller. And to prorate means to divide various charges and credits between the buyer and the seller. Contract should specify the date and timing for prorating items. The day of closing belongs to the buyer unless stated otherwise in the contract. And when we're doing prorations, the dollar amount is always the same. If you're debiting a party $100, you're going to credit the other party $100. So, should you get a proration question and you've got answers, credit, debit, credit, debit, credit, debit, it's not going to be, let's say the $100. If you've got debit seller $70, credit buyer $30, that's never going to be right if the numbers are different. So you can eliminate those two. They have to be same. Now, with the prorations math that you do in this course, they deal with taxes, which is on a year, rent that's been collected, which is on the month, and also assumed interest. All three of those will be a debit to the seller and a credit to the buyer. And an easy way to remember that is to put it in alphabetical order. B, C, D, S. Buyer, credit, debit, seller. If you can't remember it any other way. We talked about the type of prorations you're going to do in this course. Now, the proration methods is based on a 365-day method, the actual number of days in a year. Now, you're going to have to memorize those numbers of days in a month of a year. And it's going to make a difference because they will try to distract you by, if you think it's got 30 days or you give the day to the wrong person, they're going to have the right, wrong answer. Now, the easiest way for me to remember it is that they're opposite. It's always 3130 basically, okay? But there are exceptions to every rule. So you start out with 31 and you're going to end with 31. January's 31, December's 31, and then you're going to go opposite. Now remember, February is going to be 28 or 29 days. But other than that, they're going to go back opposite. 31, 30, 31, 30, 30, except for July and August. Both of those have 31. So if you just start on your piece of paper and go, okay, January's 31, 31, 28, 31, 30, and line it down. And when you get to July and August, put 31, 30, and then start with 30 again. You'll be okay. Trust me. There's some people that do the knuckle method. There's all different kind of ways to remember how these, but that's the easiest way for me. The 365-day method versus the 360-day statutory year. In Alabama, they use both of these. So you'll have to know how to do both of them. The 365-day calendar day method, you're going to have to memorize the days in, days in the month and the year. And there's all kind of different ways to memorize it. In the statutory year, that's equivalent to 30 days, no matter how many days really are, but there's 30 days in each month, which gives a total of 360 days. A little more about discount points. That's an upfront fee to increase the real yield or annual percentage rate to the lender. It allows the lender to increase the return, make more money, without increasing the interest rate, the contract interest rate. So what happens is the interest rate on the contract that they're paying every month on the unpaid balance is not the APR. That's the interest rate that they're charged on the unpaid balance. The APR includes all the cost, including discount points, for them to get that loan. So what may be 5% charged as the interest rate on the unpaid balance, in reality, when all's said and done, it's really 5.5% that they paid. How much points cost a buyer? Each point is equal to 1% of the loan amount. Not the sales amount, but the loan amount. So if the loan amount is $100,000 and you're paying 3 points, it would be $100,000 times 3%. And that's how much it would cost the buyer at closing to get the lower interest rate. Now, how much will the lender make off this? So that's known as the lender's yield, return, or APR, which we talked about in the previous slide. Each discount point paid will increase the yield to the lender by 1/8 of 1%. So let's say they got a 3% loan and they paid 3 points. How much is the APR? It's 3% plus 3/8 because there's 3 points. So the APR is truly 3 3/8%. All you do is take the number of points, put it over an 8, make a fraction out of it, add it to the original, the interest is being charged, and you got your answer. It's that simple. Now, if they're going to put it in a decimal form, all you need to do, for example, to get what 3/8 is in a decimal form, is take 3 and divide it by 8. What you see in your calculator, point what, that's what you're going to put behind the 3% or whatever percent you're working with. When it comes to real estate commissions, they're often shared by the listing broker, the listing sales associate, the selling broker, and the selling sales associate. Debt to income ratio, that's one way that a lender will decide if they believe that you have the ability to pay back the loan. How much debt do you have to the amount of income you bring in? Qualifying for a conventional mortgage loan, they take your gross monthly income. They use it to calculate the qualifying ratio for borrowers, and they use a total obligations ratio, and it cannot exceed 36%. And the way they calculate that is they take the total monthly obligations and divide it by the monthly gross income. Qualifying ratios for VA. There's no housing expense ratio, and they do have a table of residual income. They want to make sure that the veteran has enough residual income each month. And the maximum total obligations ratio for VA is 41%.
Okay, qualifying ratios for FHA, they have a housing expense ratio. That is the monthly housing expenses. They consider it principal, interest, taxes, insurance, and mortgage insurance premium. They take all that up, add it together, and divide it by the gross income. And the housing expense ratio cannot exceed 31% for FHA loans. FHA also has a qualifying total obligations ratio. It's determined the same way, and it cannot exceed 43%.
Calculating PITI. Once you find out how much the principal and interest payment's going to be per month, in a fixed amortized mortgage, it's going to be the same. So let's say that it's $1,000 a month. We're going to make it easy for mathematical purposes. And T and I stands for taxes and insurance. So let's say the property taxes are $2,400 a year and the hazard insurance is $1,200 a year. The way you're going to figure out PITI is you got your $1,000 payment and you need to pay 1/12 of $2,400 and 1/12 of $1,200. So it's going to be an additional $300 to your 1,000. So it's going to be 1,000 plus 2 plus 1. The PITI is going to be $1,300.
Information needed to amortize a mortgage. You need the outstanding debt, the principal amount owed, the interest rate, and the monthly payment. Fixed amortized mortgages, they have regular periodic payments for a fixed constant amount. And at the end of the loan term, all the principal and interest is paid in full. The payment for principal and interest is the same each month. However, in the beginning, more of that payment is applied to interest and less is applied to principal. As each payment is made, then less goes to the interest and more in the month goes to the principal.
The loan to value ratio, all you need to do is divide the loan amount by the value of the property. If we are determining the net to the seller, let's not get that confused with equity. Net to the seller is the sales price minus all the cost. That's net to the seller. Whereas equity is the sales price minus what's left to pay on the mortgage. Off we go to investment math. You're going to think you have to know rocket science to be able to do this math, but I promise you it is really simple. If you just do what I say and learn it the way I teach it, it's easy peasy. Let's first talk about the income analysis approach. It measures a flow of income projected into the future. The market value is estimated based on the present worth of future income.
Types of income: potential gross income, effective gross income, and net operating income. Your potential gross income is the annual income if your property was fully rented with no collection loss. So, for example, you have a fourplex. You rent them for $1,000 a month. 1,000 times 4 is $4,000 a month that you're getting if it's fully rented. Times 12 months is $48,000. That would be the potential gross income. But most of the time you're going to have vacancy and collections. So the effective gross income is that potential gross income less what you estimate, or they give you in the problem because they'll tell you what it is, the vacancy and collection, plus adding any other non-rental income. So if you have a big apartment complex that has soda machines, paper machines, things like that that generate income other than rental income, that's what you call the non-rental income that you're going to add to it. Then net operating income is the effective gross income less your operating expenses.
So what we just saw in the previous slide, I put it in an easier form to remember or to understand. Because when I read it the first time in that slide, it's like, okay, if I stop and cut it all up, I can figure it out. But just reading it sounds like I've got a mouthful of marbles. So here's the easiest way to remember it. I call it the PEN formula, P-E-N. The major players are your PGI, EGI, and NOI. So there's a line above the E and a line above the N. Then you just got to fill in what goes in between. So let's take this now as if it were a paycheck, like you're working an hourly job. Okay? Now this is for investment property. It's based on a year and all that. But I want to make the order in which these things are added and subtracted kind of make sense to you in our everyday world. So if you worked a job where you could work 40 hours, your potential gross income, the most you can make, would be $400 a week. Now they're going to stop and they're going to take out taxes, unemployment, Social Security, and all that crap out of your check. So we're going to call that the vacancy and collections. They're going to collect that money for the IRS, and it's going to vacate your check of some dollars. Now, the other income is not always there. It just depends on if that particular investment property has, and we're talking about like an apartment. And if an apartment unit has other things that make income for them other than the rent. So the PGI is only based on rent. Okay. The other income for the apartment complex would be maybe soda machines, laundry machines, maybe they have a rec center that they rent out for parties. Any money that that complex makes that's not considered rent is considered other income. So you have to add that back, okay, to get your EGI. Now let's go back and put it in the 40-hour work week. So you got your 40-hour work week, $400 is the max you're going to make in a week. They're going to take out taxes and all that stuff that comes out of it. That's your vacancy and collections. And then if you work on a job where you get bonuses or commissions, something like that, that would be your other income. So once you take that $400 and subtract those taxes and add back that extra that you made, now you got your effective gross income. That's what gets deposited into your bank, direct deposit. Okay? So now you got that. The next thing you're going to do is you go home and open up the door and see on the table all those bills that you got to pay. So you're going to pay some operating expenses, which there are fixed and variable. And then you also have reserves for replacements, which is a savings account for a rainy day. So you go ahead and factor all that in, take care of that, and what you have left is your net operating income, which us for the week would be our net running around money. And that's the easiest way to remember it. So if you get into the test and you've got this going on, just stop and think how our paycheck works, each line. We get the net check, we go home and pay the bills, and what's left is our running around money. That's the easiest way, I think, to keep it memorized.
Operating expenses are what contribute to the operation of a property, and there's three types. There's fixed, variable, and reserved for replacements. Fixed expenses are like your property taxes and hazard insurance that do not go up and down during the year because of occupancy. They stay the same. Variable expenses, on the other hand, will go up and down depending upon your occupancy rate. Maintenance, utilities, supplies, etc. So an example of a variable expense would be a water bill. If you as the landlord pay the water bill for your tenants in the apartment complex, the more tenants you have, the higher your water bill is going to be. And then reserved for replacements is an allowance for future replacement of building components. It's a savings account that's earmarked for replacing building components. Or maybe you're going to paint the outside of the building, repave the parking lot, things like that. That's your reserves for replacements. Now here's some expenses that are not included in operating expenses that could possibly be a little bit confusing. Depreciation, cost of mortgage, personal expenses, income taxes. Any expense that does not contribute to the operation of the property is not an operational expense, it's a business expense. Don't get mixed up if they say the rent payment for your office complex is $2,000 a month. That is not an operating expense because you could have owned a building free and clear, be using it, and not have it as an operating expense. So they don't count that as an operating expense. The formula, your very best friend when it comes to some of the math. Okay? It helps you determine, if you get a question, what the net operating income is, what the capitalization rate is, and what the value or purchase price would have been. So when you get a question about these, they're going to give you 2 out of the 3. That's all you need. If you draw this triangle and memorize how to use it with the I on top, a division line, and then the R and the V with the multiplication between it on the bottom, you're going to be golden. Because if you just look at the triangle, to find the net operating income, what am I going to do? I'm going to take the capitalization rate times the value. If I want to find the capitalization rate, I'm going to take the net operating income and divide it by the value. And if I'm looking for the value, I'm going to take the net operating income and divide it by the capitalization rate.
These last two, gross rent multiplier and gross income multiplier, are ways to determine value for investment property. Gross rent multiplier is for like investment homes where you use them as rentals or whatever, and it's based on the gross monthly rent. Gross income multiplier is a business, an actual business, not just a house that's rented. So what it does is it uses the annual income and rent from other sources. Most likely question you'll get on these is what does gross rent multiplier base its whatever on? Gross rent multiplier, think of you rent a house per month, that's the monthly. Gross income multiplier, remember that's the businesses, strip malls or whatever. And if you think about it, our PIN formula is based on annual income. So that's going to be on the annual income. So rent multiplier is monthly. Gross income multiplier is annual. Loan commitment fees is a banking term used to describe a fee charged by a lender to a borrower to compensate the lender for its commitment to lend. Commitment fees typically are associated with unused credit lines or undisbursed loans. Prepayment penalties. A prepayment penalty clause states that a penalty will be assessed if the borrower significantly pays down or pays off the mortgage. Now, it can be collected in one or two manners. It's going to either be a percentage of the remaining principal balance or a percentage of the remaining interest owed. Calculating linear feet. How much baseboard is needed for a room that measures 20 foot by 15 foot? 20 foot equals 40 foot because it's twice. 15 foot equals 30 feet because it's twice. You add them together and you need 70 feet. Land unit and measurements. A property on the Gulf sells for $5,500 a front foot. Oof. The property has 50 front feet of water on the Gulf. How much is the property worth? 5,500 times 50 feet means it's worth $275,000. Cost per front foot. A property measures 350 feet by 600 feet, and it's sold for $56,000. What is the cost per front foot? Now, first of all, I want to remind you that the very first number is your front feet. So you're dealing with 350 feet. So all you do is take the cost divided by the front foot, and you've got $160 per front foot. Rectangle. A property has a rectangular patio that is 30 feet by 25 feet. What is the area of this patio? Simply multiply it. 30 feet times 25 feet is 750 feet. Square. The property you're going to list has an addition that was built a few years ago. The addition is a living room measuring 20 feet by 30 feet and a dining room that measures 15 feet by 10 feet. What is the total square footage of that entire addition? Simply take 20 times 30 feet, that's 600 feet. Then the dining room's 15 feet by 10 feet, that's 150 feet. Add them together and you got 750 feet. Rectangular prism in meters. You're going to calculate the volume in cubic meters of a rectangular prism that is 7 meters long, 5 meters wide, and 3.5 meters high. So basically all you're going to do is take that 7 times 5 times 3.5 and you have 122.5 meters. A rectangular prism in centimeters. Now there's a hint here. Both meters and centimeters are calculated the same way. So we're going to do this one just like we did the other one. Calculate the volume in cubic centimeters of a rectangle prism that is 3 centimeters long, 2 centimeters wide, and 3 centimeters high. Simply 3 times 2 times 3. And your 18 centimeters is your answer. Okay, now we're getting a little tough. This is going to prorate taxes on a 365-day method where the buyer pays the taxes in arrears. So the closing date is October 13th and the buyer owns a closing day. Taxes are $2,100 for the year. So the first thing you're going to do is take that $2,100 and divide it by 365 days to get your per diem, your per day rate. You've got to figure out how many days the seller owes, and once you figure that out, you multiply the 5.75 times 285, and the seller's going to owe the buyer $1,638.75. And the reason why the seller owes the buyer is because the buyer's going to pay the tax bill at the end of the year. And the seller's lived in it from January 1st to basically October 12th. You gotta watch when you're counting your days and make sure you know who owns the closing day, because it makes a difference, and they'll have right and wrong answers in there to distract you. Okay, this is basically the same problem or the same question. It's just this time the seller's already paid the taxes. So that means the buyer is going to owe the seller for the amount of year that the buyer's living in the house that the seller already paid the taxes for. Okay, closing date is 10/13 and buyer owns a closing day. Taxes are $2,100 for the year. You're going to divide that out by 365, and you can either round up or you can take it out 3. On your test, it's not going to make a difference because they're not going to make the question so close that if you messed up on rounding or didn't round, that they would have an answer that looked like that. So you're going to take what you get in your calculator and multiply it times 80, because that's how many days that the buyer's living in the property and owes the seller for the unpaid taxes, and that's $460. Prorating taxes, 360-day method, that's a statutory year. This is where the buyer's going to pay the taxes after the closing. They're going to pay it in arrears. Closing date is July 13th. Buyer owns the closing date. Taxes are $2,100 for the year. In this instance, it's 282 seller days. Remember, there's only 30 days in a month. You're going to take the $2,100 divided by 360 and multiply it times the 282 days, and $1,644.06 is what the seller owes the buyer. Prorating taxes, the 360 statutory year where the seller has already paid for the taxes. So your closing date is July 13th. The taxes for the year are $2,100. The buyer's days are 79 because remember, each month is based on 30 days. So $2,100 divided by 360 days tells you what it is per day. They have 79 days, so the buyer owes the seller $460.81. Now it's time to prorate some rent. Okay, we're going to use a 365-day method for this. Again, I'm keeping the closing day the same, 10/13. Buyer owns a closing day. Rent is $2,100. Buyer has 19 days of the month that the seller owes the buyer for, because the buyer collects that rent at the first of the month. So he needs to pay him the amount of days that the buyer owns the rental property, the rent that is owed for those days. So we determined that was 19. 2,100 divided by 31, because there's 31 days in October, gives you 67.74. You multiply it times the 19 days owed, and the seller owes the buyer $1,287.10. We're going to do discount points. What is the cost of them? Okay, so the loan amount's $250,000, and the points that are going to be charged to receive a 3% interest rate is 5. So how do we figure out how much these discount points cost? All you do is take that loan amount of $250,000 and multiply it times 5%. Because remember, each point equals 1% of the loan amount, and your total is $12,500. Oh, yeah, P, let's do some lender's yield. Okay, discounted interest rate for paying those 5 points, remember, was 3%. We want to know what's the lender's yield. So remember, each point equals 1/8 of 1%. So all you're going to do is put a 5 over the 8 and add it to 3%. So 3% plus 5/8% equals 3 5/8%, which is the APR, the lender's yield. What's your DTI? That means what's your debt to income ratio? Well, we take the gross income, which in this case is $6,500. The total housing cost, and we're talking about PITI, is $1,450. Now the total obligations, and that includes that house payment, is $2,250. They want to know what the housing expense ratio is. So all we do is take the housing cost, and it's divided by the 6,500, which gives you a 22.3%. And then what they want to know is what is the total obligations ratio, or sometimes it's referred to DTI. So you're going to take the 2250, which is everything, and divide it by the 6500, and their DTI is 34.6%. Loan to value ratio. Now this one kind of tells on itself. You've got the formula in the parentheses. Loan to value, loan divided by value. So you've got a sales price of $600,000, a down payment of $180,000, a loan amount of $420,000, and they want to know what the LTV is. So you're going to take the loan amount, which is $420,000, and you're going to divide it by the sales price, which is $60,000. So the loan to value is 70%. Let's do some seller proceeds. So what's the net to the seller when this house finally closes and everybody walks away? The sales price is $350,000. You got $12,000 of closing cost, $21,000 of commission, and the mortgage that needs to be paid off is $139,000. All you're going to do is subtract everything, and you're come out with a net to the seller of $178,000. Now this is not a net listing. This is what they call a minimum offer acceptable, because the seller wants to net a certain amount. It doesn't mean like a net listing. They're saying, okay, I need to make at least $20,000 off this house when I sell it. That's what they're talking about. They're not talking about the other type of net. So the formula is you take the sales price. Now what that equals is the net amount plus the mortgage or other expenses divided by 100% minus the commission rate. Now I know it sounds like a mouth of marbles. So here we are. The seller still owes $54,000 on her mortgage, but she wants to net $40,000 after the mortgage is paid, the closing cost of $7,895 is paid, and the 7% commissions paid. She wants to walk away with $40,000. So what does she need to sell this house for? You take the $54,000 plus the $40,000, because that's the base that she wants out of it. She wants to be able to pay off the mortgage and take $40,000. Then you're going to add the closing costs, because we got to account for those. That's a plus a $7,895. Now you've got a total of money of $101,895. But we still got to factor in that commission, and that's done a little unusual. If you ask me, I would think it was done a different way, and most people do when they first think about it. But you're going to divide. And what you're going to divide, you're going to take that total figure that we just got and divide it by the difference in 100% and the commission rate, which in this case, they want 7%, so they're going to divide it by 93%. So the house should sell for somewhere around $109,564.51, or an agent may round it up to $109,600 or just $110,000. But it's really simple. It just sounds complicated. This is a very long one, but it's simple. But when I tell you all these things, it's going to sound like, oh my God, help me. But no, it's really simple. So we're going to calculate principal and interest. What that means is we're going to take what the payment is, and we're going to figure out when you pay the bank that mortgage payment, how much of that is going to go to the bank's pocket as interest, and how much is it going to your loan to reduce it. You'll be surprised. Okay. So the formula is, and I'm just going to read this, and once you do this 2 or 3 times, you'll have it down. The amount owed, your principal balance, and then you're going to multiply it times the interest rate. The answer you have there is the first year's interest, but all we need is 1 month, so we're going to divide that figure by 12. Okay, so now we got the first month's amount of interest. We grab the information of the monthly payment, subtract that interest from it, and that will tell you how much principal is paid towards your loan. Now, if they make you do it for 2 or 3 months in a row, the only thing you're going to have to do, other than repeat the whole thing over again, is that, let me make it up, $45 went to the principal amount. Okay, you're going to subtract that $45 from the principal amount because you don't owe it no more, and now you have a new principal amount. Now you start all over again. The new principal amount times the interest rate divided by 12, subtract that month's interest from the monthly payment, and you got your answers. Now, how does this look in math? So, in this case, $159,000 at 4%, where the monthly payment is $750. They have to give you those 3 pieces of information. So the first thing you're going to do is take the $159,000 and multiply it times the interest rate of 4%. So that year's worth of interest would equal $63.60. But we don't need all that. We just need 1 month of it. So we need to divide by 12. So of that payment of $750, $530 is going into the bank's pocket, and the $159,000 is being reduced by only $220 of the $750 payment. And then you just redo it again. Just remember, you got to remember to subtract whatever was paid to the principal before you start the second month, and then just keep doing that again. Prepayment penalty. Remaining principal balance is $50,000. Now, they want to pay it off early, and so they're going to have to pay this prepayment penalty. The first way could be a percentage of the remaining balance. For instance, this one's 3% of the remaining principal. So you just take $50,000, which is the remaining principal, times 3%. They'll have to pay a $1,500 prepayment penalty. Now, if they do a percentage of interest that's left, that's a little bit more entailed, and here it is. A percentage of the remaining interest. They want 70% of interest of 6 months at 5%. Okay, so the first thing we're going to do since it's not a whole year, it's just 6 months, we're going to divide that interest rate in half. So $50,000 times 2.5% is $1,250 for 6 months interest. But they only want you to pay 70% of it. So you multiply it times 70%, and what you're paying here would be $875. Investment math. Potential gross income, $48,000. Vacancy and collection is 8%. So you're actually making 92% of your potential gross income. Other income is $3,000. Operating expensing is $12,000. What's your net operating income? $48,000 times 92%, $43,200. Then you add your other income, and your effective gross income is $46,200. You're going to subtract your operating expenses, and your net operating income will be $31,200. Gross merit multiplier. A triplex is selling for $750,000. Each unit can gross $1,800 a month rent for the owner. So you got to remember to multiply that times 3 because there's 3 units. What's the GRM? $750,000 divided by 5,400 is $138.89. Gross income multiplier. A 10-unit apartment building sold for $7 million. The property can gross $550,000 in annual gross income. What's the GIM? Take the $7 million divided by the $550,000 and you have 12.73.